Uh, Good evening, everybody. Hope you had a good day. So we are heading into the final day of our this 5-day webinar session. Tomorrow is going to be a mock debrief session. So if I actually could recall what we did in the yesterday's class. So what we did in the yesterday's class was we went through the assurance area and we did discuss that what exactly are these assurance engagement, what are the various types of engagement, we talked about them, and the various types of engagement we discussed that what is the objective of having ISRE, we discussed that what is the objective of having ISRS, and in addition to this, what are those ISAE, the assurance engagement, etc. So we talked about all of them. And when we discussed about all of them, so what we actually did was we also went through a few of the exam questions in which we discussed that how the environmental and the social responsibilities are actually presented by the organization and how the audit firm actually handles those things. We also talked about the performance information. So we talked about the performance information, financial information, that what exactly are these prospective financial statements. So I talked about it, that they comprise of the forecast and they comprise of the projections. And I did ask you people to actually try and attempt a question which was December 2016, question number 3. And I actually told you people that if you want to do this question, what you need to do is that you need to calculate the growth rates and you need to test the numbers against the notes given. So we had all this discussion. Now what we are going to do is we are now going to move forward today and quickly complete this question, discuss a few things about due diligence, and then we would have uh, a discussion of the section A of the syllabus, which is the quality control, the ethical and the professional issues. So we will have a discussion pertaining to all this. So right now it's a namaz time, so we would have a short break for namaz. We're going to resume at 6:20 p.m. So this is 27th of October. We're going to resume at 6:20 p.m. Okay ji. Now let's start off. So we were actually doing this December 2016. You're doing December 2016. Question number 3. Now let's just talk about this December 2016 question number 3. So if I talk about this December 16 question number 3, it was like that the company has done this 30th September 2016 during a visit to the team performing fieldwork. The audit senior shows you a cash flow forecast covering the 6 months periods to 30th September 2018 as prepared by management as part of their assessment of the going concern status. So on. So now when we talk about this, so let's discuss. If we say that operating cash flow 31st March 2016, 30th September 2016, I did ask you people to perform the calculations. Have you performed the calculations? Okay, just in case if I am unable to do it today, forensic auditing, I would cover it in the tomorrow's session. Don't worry about it. Okay, here if I say that what are going to be the various procedures, various things that we need to do in order to test the reasonableness of these assumptions, because the question's requirement was evaluate the appropriateness of the cash flow forecast which are prepared by so and so, so and so. Now, if I talk about it, number one thing is what I'm going to do is that it says operating cash flows means receipts from customers. So the additional information says receipts from customers and payment to suppliers have been estimated based on detailed sales forecasts prepared by the sales director. So the sales director's sales forecast. So what we need to do is that we need to compare the forecast prepared earlier with actual results for the past periods. Number two thing is we need to prepare the forecast for the prepared with the actual result for the past periods. Furthermore, inquire from management about reasonableness of the growth rates, compare sales/payment growth rate with the historical data. I am unable to get these numbers from you people, otherwise I would have been more able to comment on the appropriateness, but anyways, it says salaries and overheads have been estimated as the prior year cost plus general inflation of 2%. Now, if we say that plus the general inflation of 2%, so I would say for the salaries and overheads, the use of general inflation is inappropriate. The use of general inflation is inappropriate. They should have used specific inflation. Now, if we discuss further, so other operating cash payments, it's 1875, then 1850, then 1930, then 1887. So apparently it seems that in the first 6 months, these other operating cash payments are usually higher, but in the subsequent ones, they become a bit lower. So we need to actually understand the reason for this specific thing, that what is the reason. So you need to inquire from management about the reason for this difference in the other operating payments in the last 6 months. It says the bank loan expires on 5th January 2018. The finance director expects to take out a matching facility with the current lender to pay off the existing debt. So we need to inspect agreements / correspondence with the current lender to see if there is a likelihood of payments to be made by them. On 1st October 2015, Chief Executive gave the company a 3-year interest-free loan secured by a fixed charge over the operational assets of Rope. Audit team was unaware of this loan prior to obtaining the cash flow forecast. So, if I talk about this loan from Mr. J. Stewart, so what happens is that you need to inspect the agreement with J. Stewart to confirm loan amount and terms and conditions. Okay, let's discuss further. So there was this repayment of the bank loan. So what we need to do is that inspect bank loan agreement to a certain repayment date. For the opening cash, it says the directors plan to sell some investment in listed shares to fund the repayment of chief executive loan. At 30th September, investments were carried in SOFP at their fair value of 350,000. So what we need to do is that we need to actually inquire the basis on which these investments are valued at a future date. Then what you could do is that you could trace balance of cash in the SOFP with the balance shown in cash flow forecast. So these are the various things which we could actually suggest them that for the appropriateness of the forecast that has been prepared, you needed to actually have the numbers, which unfortunately are not being calculated right now. So if you have the numbers, so you could compare and you could comment more about the appropriateness, but the further audit procedure that needs to be performed, I have written them down. So I hope that this is clear. There is another requirement which is comment on matters to be considered in respect of the loan from Mr. J. Stewart, and recommend the further audit procedures to be performed. It says comment on the matters to be considered in respect of the loan from Mr. J. Stewart and recommend further audit procedures to be performed. So what we are going to do is that It's similar to the earlier requirements that we have discussed, which were actually about the finalization stage of the audit, which is comment on the matters to be considered and recommend the audit procedure procedures to be performed. So these were the things which were actually discussed earlier. Okay, now, so the next area that we are going to move to is due diligence. Now let's just talk about the due diligence, that what exactly is the due diligence. So I'm going to have a quick discussion about the due diligence, that what do you mean by due diligence. If I explain that what is a due diligence, so due diligence is can either be a review engagement, can either be an assurance engagement, or it could either be a related services engagement. It could be any. So when we talk about due diligence, the due diligence is an engagement performed by the, what do you mean by due diligence? Due diligence is the engagement performed by the acquirer on acquiry. 2. Due diligence is the engagement performed by the acquirer on acquiry before acquisition. So the due diligence is the engagement performed by the acquirer pertaining to acquiry before the acquisition. Now let's discuss further. So basically what happens in the due diligence is that there are various types of due diligence. Now if I recall that what are the various types of due diligence exercises, so you could actually come across the various due diligence, which includes the financial due diligence, which includes the commercial due diligence, which includes the legal due diligence, the HR due diligence, the operational due diligence, the technical due diligence, the tax due diligence. So the due diligence is basically an engagement performed by the acquirer pertaining to acquiry before acquisition. Now what exactly is it? If I want to acquire a company, what I would try to do is I would try to actually have a evaluation about whether I should go ahead with the buying of this company or not. I should go ahead with buying this company or not. Now, if I need to actually perform an evaluation whether I should go ahead with buying this company or not, so what am I gonna do? I'm gonna actually do certain things, which is I would try to go through the financial statements of those company to check that if the assets exist, at the same time their values, etc. And at the same time if the liabilities exist and their correct values. Same goes for income and expenditures, that if we do have the income and expenditures, etc., etc. So the number one thing is the financials due diligence, which would actually involve the financial statements, and it's not just gonna be the historical financials. At times the projected financial statements would also be available. At times the projected financial statements would also be available. Furthermore, if I talk about this commercial due diligence, so the commercial due diligence is, at times what happens is there are few businesses which are commercially not viable. So are they commercially viable or not? I mean, the margins or the profits involved, that's also a question. So basically the margins and the profits involved is also a question. So what happens is margins / profits involved. Furthermore, legal due diligence, if there are to check if there are no unrecognized slash unbooked liabilities. So the legal due diligence is to actually check if there are no unrecognized or no unbooked liabilities. The HR due diligence to check if the contracts with employees are valid and for how long. Furthermore, if we talk about the operational, what are the operational issues involved, etc. Then there is this technical due diligence, which is actually about what are the technological issues involved. And then we have got a tax due diligence. And what is this tax due diligence? The tax due diligence is basically the tax liabilities and the tax cases, etc. So when we acquire a company, so what we need to do is that we need to be sure of what we are getting. And in order to do that, we actually assess various aspects of the business. At times, majority of the times what happens is you just acquire a company on the basis of the financial evaluation. You just see that what are the financial statements of the company, what are they showing, and you acquire the company on the basis of those financial statements. But majority of the times what happens is that if you acquire a company, you just not look at the historical financial, you try to look at the projected financial statements like the future cash flows, future profit and loss account, future balance sheet, etc. You try to look into those also. At the same time, when we talk about the commercial, when we talk about this commercial due diligence, so the commercial due diligence would actually involve you looking at the prospective business as whether that is commercial, are there the commercial benefits or the commercial considerations involved in those business or not. Furthermore, when we talk about the legal due diligence, so that actually involves that at times what happens is there are a lot of court cases, etc., which are usually not declared or not disclosed. So you need to see if there is any legal due diligence, I mean any unrecognized or unbooked liabilities. For the HR, at times organizations are dependent upon the employees. So you need to see if the employees are actually, you need to see if the employees are actually you need to see the employees are going to stay back long, or at times what happens is you don't want those employees to continue, so would that be easy to get rid of those employees? So that's also an important thing. Then there is this operational, so are there the operational issues involved or not? That's also a question mark. Then the technical, which is that at times what happens is the technological advancements are there, and you are unable to usually match them, you're unable to usually catch them, so that's also a problem. And lastly, the taxation. So if the tax authorities are being satisfied, if the tax liabilities are being settled, etc., these are all important things. So basically what happens is we perform various procedures, we look at the various aspects of the business whenever we do perform the due diligence. Now, how do we actually tackle due diligence? In order to do that, let's just come on to a question which is, okay, this is actually December 2013. This is actually December 2013. And when we talk about December 2013, it's question number 2 of December 2013. It's December 2013, question number 2. So the question's requirement is discuss the 3 benefits to Baltimore of a due diligence. The second is identify the matters which we would focus on in your due diligence review and recommend. The additional information you will need to perform your work and describe the type of conclusions. So these are the 3 requirements if you have to go through. So let's take 5-6 minutes and try to attempt it. So let's start off this December 2013 question number 2. Okay, so if we talk about this question, it says you are a manager in the business advisory department of Golin and Co. Your firm has been approached to provide assurance to Baltimore company, a company which is not an audit client of your firm, on potential acquisition. You have just had a conversation with Mark Clare, the Baltimore company's managing director, who made the following comments. Now, it says Baltimore company is a book publisher specializing in publishing textbooks and academic journals. In the last few years, the market has changed significantly. With the majority of customers purchasing books from online sellers, and this has led to a reduction in the profits, and we recognize that we need to diversify our product range, etc., etc. As a result of this, we decided to offer a subscription-based website to customers, which could provide the customer with access to our full range of textbooks and journals. On investigating how to set up this website, we found that we lack sufficient knowledge and resources to develop it ourselves, and we began to look for another company which has the necessary skills with a view to acquiring the company. We have identified Mizzen Company as a potential acquisition, and we have approached the bank for a loan which will be used to finance the acquisition if it goes ahead. Now it says the Baltimore has not previously acquired any other company. We would like to engage your firm to provide guidance regarding the acquisition. I understand that a due diligence review would be advisable prior to deciding on whether to go ahead with the acquisition, but other directors are not sure that this is required, and they don't understand what the review would involve. They were also unsure about the type of conclusion that would be issued and whether it would be similar to the opinion in an audit report. Now let's see. If we actually talk about it, so what are we going to do? The first requirement is discuss 3 benefits to Baltimore company of a due diligence review being performed on Mizzen company. So what do you need to do? You need to discuss the 3 benefits to Baltimore company of a due diligence review being performed on Mizzen company. So now, if we talk about the advantages of due diligence review, let's talk about it. If I discuss the advantage of due diligence review, so one of the advantages of the due diligence review is basically that you could better valuation. One of them is a better valuation. Idea about the challenges to be faced post acquisition, and better decision. Furthermore, it says identify and explain the matters which you would focus in your due diligence review. If I talk about requirement, this is the requirement A of the question. If I talk about the requirement C of the question, I'm not going on to requirement B right now. I'm going on to requirement requirement C of the question. It says that describe the type of conclusion which will be issued for a due diligence report and compare this to an audit report. So you need to describe the type of conclusion which would be issued for a due diligence report and compare this to an audit report. So if we say what is the difference, so you do know that for the audit report we have got a positive form of opinion, and for the due diligence report we have got a negative form of opinion. Now what else is there? So if I say, it says Mark Clare has sent you the following information about Mizzen Company. It says Mizzen was established 4 years ago by two universities. Now the point is, the requirement of the question is that you need to identify and explain the matters which you would focus on in your due diligence review and recommend additional information which you will need to perform your work. So if we talk about the matters, so you need to see that you just need to, whenever you are performing a due diligence, you just need to think that what are the things which you are going to consider if you are acquiring your own business. You need to see what are the things which you are going to consider when you are acquiring your own business. Taj Muhammad Khan, due diligence review is generally, if it's a review, the review is always a negative form of opinion. But there could actually be reasonable assurance engagement under ISAE also, that could actually, there the report would differ. But generally, if the due diligence is a review exercise, review means that ISRE follows, and ISRE always has a negative form of opinion. Now, if I move further, it says the company background. So I was telling you that you need to discuss that what would have been. Okay, Azim, we discussed yesterday also that there are different types. When you use the historical financial statements, so if the historical financial statements, the procedure being performed on historical financial statement but less than audit procedures being performed, so then that's actually a review exercise. And what is a due diligence exercise? The assurance exercise, the assurance engagement, which is ISAE, it's actually something that covers other than historical financial information. So now let's see. If we talk about it, so what's going to happen? Mizzen was established 4 years ago by two university graduates, Vic Sindhu and Lou Lian, who secured funds from a venture capitalist company to set up the company. Vic and Lou created a new type of website interface which has proven extremely popular and which led to the company growing rapidly and building a good reputation. They continue to innovate and have won awards for website design. Vic and Lou have a minority shareholding in Mizzen Company. So now the number one point is, if we acquire Mizzen Company, will Vic and Lou accompany us? The next thing is, what will be the role/capacity of Vic and Lou? So that's also important. It says Mizzen Company employs 50 people and operates from premises owned by BizGrow, for which a nominal rent of $1,000 is paid annually. So what happens is that there are 50 people employed. So you need to see that the contracts with them. At the same time, operates from a premises owned by BizGrow, for which a nominal rent of $1,000 is paid annually. Will BizGrow allow us to use this premises later on, and at what rentals? It says the company uses other few assets other than computer equipment and fixtures and fittings. The biggest expense is wages and salaries due to increased demand for website development. Freelance specialists have been used in the last 6 months. So, are freelancers easily available? will these freelancers become our future competitors? Because what happens is you're using them for designing the customer's website. Furthermore, it says, according to most recent audited financials, Mizzen has a bank balance of $500,000. So what you could actually say is that the liquidity issues, are there any? Because there is low cash balance. It says the company has 3 revenue streams. Now what are those 3 revenue streams from the company? The number one of them is it says developing and maintaining websites for corporate customers. Mizzen charges a one-off fee the question would guide you. Azim, the question would guide you. Now it says the company has 3 revenue streams. Developing and maintaining websites for corporate customers, that's number one. So what is it? It's developing and maintaining websites for corporate customers. Mizzen charges a one-off fee to its customers for the initial development of a website and for maintaining the website for 2 years. So the business model is you charge an upfront fee, which includes the initial development and which includes the subsequent maintenance. The amount of this fee depends on the size and complexity of the website and averages at $10,000 per website. The customers can then choose to pay another one-off fee averaging $2,000 for Mizzen to provide maintenance for a further 5 years. Now what happens is you are acquiring a company, so the factors that you need to consider are that is the revenue currently recognized includes if the revenue currently recognized includes the maintenance fee for the 2 years received in advance. Furthermore, you could see that there are few customers who are paying additional $2,000. So now if I acquire Mizzen company, so that means these liabilities are going to accompany me, because there might be a possibility that existing Mizzen company's management would have consumed the money, and then I would actually be held liable, or you would actually be held liable to maintain this company's subsequent servicing of the customer's requirement. So we need to establish the liabilities pertaining to undelivered services. Furthermore, if we move forward, so you could actually see that it says Mizzen has also developed a subscription-based website on which it provides access to technical material for computer specialists. Customers pay an annual fee of $250, which gives them unlimited access to the website. This accounts for approximately 30% of the Mizzen's total revenue. So this 30% revenue is it sustainable? Like, why are we asking this question if it is sustainable or not? So you need to actually see that if this 30% sales revenue, if is it sustainable or not. Now what actually happens is that when we talk about this 30% sales revenue, this would actually mean that if this subscription service is not obtained by customers in future, then so the 30%, is it sustained? If the subscription is not obtained, then this revenue stream may be lost. Because you see everything, there used to be a time when we used to pay subscription for a lot of things, but nowadays everything could be Googled for free. So what about this specific thing? Will it be available subsequently or not? Namira, can you see it now? Okay. Additionally, if I discuss, it says company has built up several customer databases which are made available for a fee to other companies for marketing purposes. This is the smallest revenue stream, accounting for approximately 20% of Mizzen company's total revenue. So if we talk about these customer databases, accounting for 20% of revenue, so you would say that if the data becomes obsolete, then this revenue stream might also be lost. You go to the service providers, these telephone, mobile phone companies, service providers, what they would do is that they would take a certain money from you, and they would run SMS campaigns on your behalf. So like what happens is that there comes a time when you run the campaigns through them and there is no response. There comes a time when you run the campaigns through them and there is no response. So that's also something that you need to actually understand. So basically over here, if I am considering acquiring this Mizzen company, I need to understand that the 20% revenue belongs to the data where the customer database is actually being used and is being used for the marketing on behalf of the various people. So if your customer database is not updated by the adding up of new customers, then the existing database would be useless database for the potential people who are using your database. Secondly, so this revenue might be lost if the customer base does not grow. The 30% sales revenue from the subscription based website, considering the Google days, it might not be, it may just be a matter of time that this might also be lost. The remaining 50%, so we are concerned that of what proportion of that 50% is actually deferred, and what proportion of that 50% of that subscription and that in fact maintenance cost. We need to establish the liability, that to what extent the maintenance is outstanding. That's all important. You've got the profit and loss account also, so you could perform some analytical procedures. You could actually calculate the growth rate, and you could calculate the operating profit margin accordingly, and you would see that the profits are going up and profit before tax are going up, and resultingly it says there were no items of other comprehensive. So apparently the sales revenue has increased, so it's very important that 100% of the receipts from the customers who want the website to be developed is not recognized as revenue. That's very, very important. So I hope that this clarifies the situation. Osama, yes, what would happen is that these are the issues you need to consider, and the procedures could be that you could try to check these various things. Like for example, I talked about these factors that revenue sustainable, so you may take management representation, etc. But over here in this question, you are not required to perform the procedures. Okay, so we are done with this due diligence. This is an area that we had to actually go through and we are done with it. So what I'm going to do now is that I'm now going to move on to the next area of the syllabus, and that is section A, section B, and section C of the syllabus. So this section A, section B, and section C of the syllabus, um, we're going to start it off after a break of 10 minutes to 7:30 p.m. Those who want to offer namaz can offer the namaz so that we can then have a 1.5 hour session for section A, section B, and section C. Okay, so now let's move forward and let's just discuss few more things. So what we are going to do now is that we are now going to move on to the next area of the syllabus. And what is that next area of the syllabus? So the next area of the syllabus is basically section A, section B, and section C. And what exactly does section A, B, and C states? It's actually the ethical, professional, and the quality control issues that generally arise. So what I'm going to do here is that I'm just simply copying down one of the requirements to the question. I'm simply copying down one of the requirements to the question. You see, this is actually a typical requirement of a question that generally arises. And what is that typical requirement? Which is that the question requirement that comes in is basically the identify and discuss the ethical and other professional issues raised and recommend any actions that should be taken in respect of Tedbury Company, Stratford Company, and Banbury Company. So if we talk about it, what are we gonna do? The questions requirement are actually discuss the ethical and other professional issues raised and recommend any actions that should be taken in respect of them. Now, if I talk about them, number one of them is what are the ethical issues. So you do have an idea whenever we talk about the ethical issues would actually be there are various ethical issues which could actually be integrity. There could actually be the ethical issue of objectivity, and then there is this ethical issue of professional competence and due care. Then there is this confidentiality. And in addition to the confidentiality, there is this ethical issue of professional behavior. So these are the various ethical issues that actually arise. In addition to this, if we talk about it, so the various ethical issues could actually be number one, integrity, objectivity. There is this professional competence and due care. There is this confidentiality and professional behavior. So these are the various ethical issues that actually arise. Now if I move forward, if I discuss further, so these are the various ethical issues. In addition to these various ethical issues, we also have got, there are various ethical threats to independence that also arise. There are various ethical threats to independence that also arise. And what are those ethical threats to independence? That includes the self-interest threat. That includes the self-review threat. That includes the intimidation. Advocacy and familiarity. In addition to this, there are other threats like conflict of interest, management role, so these are the various threats that actually arise. So now what happens is, whenever we do come across a scenario, what we need to do is that we need to actually whenever we do come across a scenario, what we need to do is that we need to actually so the suggested approach is, whenever you come across a question, what you do is that you prepare a grid of these various ethical issues, and you try to tick mark onto this grid that what are the ethical issues that exist in a given scenario. So the ethical issues could be about integrity, objectivity, professional competence and due care, confidentiality, and then so these are the various threats. So whenever you come across a question, what you need to do is that you just need to try and identify that what are the similarities between them. So what I would actually suggest you people to do is that just come on to this question, which is question number 4 of December 2013. So it's December 2013, question number 4. And what you need to do is that the question's requirement says discuss, identify and discuss ethical and other professional issues raised and recommend any actions that should be taken in respect of Tedbury, Stratford and Banbury Company. So try to go through this question and we shall discuss them. Okay. So let's start off. Now, one thing that I would want you people to remember is that don't try to separately discuss ethical and professional issues. Don't try to bifurcate them. Don't try to bifurcate them. What you should do is that you should actually um, don't try to bifurcate them. What you should do is that you should simply write down in the exam without specifically highlighting whether it's an ethical or professional issue. In fact, you just need to write down that the various ethical and the professional issues that have arisen in the given scenario are so and so. Now, let's discuss. You're audit manager in Chester and Go, and you're reviewing 3 situations which have recently arisen with respect to potential and existing auditing clients of your firm. Now it says, Tadbury's managing director, Johan Stanton, has approached Chester and Co. to invite the firm to tender for its audit. Tadbury is a small owner-managed company providing financial services such as arranging mortgages and advising on pension plans. The company's previous auditors recently resigned. Johan Stanton states that this was due to a disagreement on the accounting treatment of commission earned, and because they thought our controls were not very good. You are aware that Tedbury has been investigated by the Financial Services Authority for alleged non-compliance. As well as performing the audit, Yuan would like Chester and Co. to give business development advice. Now, if I talk about this specific scenario, what my suggestion to you people also in the examination is going to be, you should try to prepare a grid, and in that grid what you should do is that you should try to identify that what are the relevant things. So if I say the integrity is yes an issue because the management had a disagreement with the auditor. Furthermore, they are being investigated by the Financial Services Authority for alleged non-compliance with regulations. Objectivity, obviously the independence issue always prevails some way or the other. Furthermore, confidentiality, professional competence could be the case. You would say, how is professional competence the case? Because what would happen is, I would say that in this specific scenario, integrity is an issue because the company is already being tried and tested under the financial services by the Financial Services Authority for the potential issue. Then at the same time, professional competence is an issue because this company provides financial services. So if it provides financial services, that means it's a specialized industry. So that could be the case. The professional behavior, no. The ethical threats to independence would actually include the ethical threats would be the self-interest threat. Will there be a self-interest threat? Apparently no. Will there be a self-review threat? Apparently no. Is there an intimidation threat? Then again no. Advocacy? No. Familiarity? Apparently no. So what are going to be the issues? The issues are going to be that we would have problems with this, the self-interest, the integrity of the management is in doubt. We need to decide if we should go ahead with it or not. At the same time, the professional competence and the due care is an issue. That is also an important issue. Let's talk further. So we've got Tedbury company, then we've got a Stratford company. It says audit of a Stratford company's financials for the year ended 30th November 2013 will commence shortly. Wait a bit, I'm missing out some point that you are actually mentioning. Okay, as well as okay, this one is as well as last line. Okay, sorry, I missed out. As well as performing the audit, Johan would like Chester and Co to give business development advice. Now see, uh, this is a management role. This is a management role. Now, why is it a management role? Let's just try to understand. Basically, the management knows how to go for business development. It's not something that the auditor has to do. So, if you perform any of the tasks which normally a management would perform, then that means you are playing a management role, and that is also an ethical issue that arises. The audit of a Stratford company, let's talk about it. It says the audit of a Stratford company's financials for the year ended 30th November 2013 will commence shortly. You are aware that the company is in financial difficulties. So 30th November 2013 will commence shortly. The company is in financial difficulties. Stratford's managing director has requested that audit engagement partner accompanies him to a meeting with a bank where a new loan will be discussed and the draft finance is reviewed. Colin has hinted that if the partner does not accompany him to the meeting, he will put the audit out to tender. In addition, an invoice relating to interim audit work in 2013 has not yet been paid. Now, if I talk about it, so what happens is that it says you are aware that the company is in financial difficulties, and Stratford's managing director Colin Challecott has requested that the audit engagement partner accompanies him to a meeting with the bank where a new loan will be discussed. So if we say integrity, maybe no. Objectivity, yes. Confidentiality, maybe no. Professional competence and due care, no. Professional behavior, apparently no. Now, self-interest threat, yes. Long outstanding fee. Will there be a self-review threat? No. Is there an intimidation threat? Yes, there is an intimidation threat. They are saying that they would actually remove us from the audit position if we actually don't accompany them. Furthermore, advocacy threat, yes. You might actually be advocating on behalf of them because you're there for the loan, you're there for actually explaining the financials. Furthermore, yes, there is going to be a management role also because negotiation should not be part and parcel of your job. Negotiation should not be part and parcel of your job. The last one of them is Banbury Company. So now, see, it says Banbury Company, the listed entity, and its audit committee has asked Chester to perform an actuarial valuation on the company's defined benefit pension plan. It would not be a self-review threat because you're not actually auditing the finances that have been prepared by you. The finances have been prepared by somebody. It says that you need to accompany them and you need to explain the finances. Now, it says Banbury, the listed entity, and its audit committee has asked Chester and Co. to perform an actuarial valuation on the company's defined benefit pension plan One of the audit partners is qualified actuary and the necessary skills and expertise to perform the service. Banbury had a year ending 28 Feb 2014 and the audit planning is due to commence next week. Its financials for year ended in respect of which the audit report was unmodified included total assets of 35 million and pension liability of 105,000. If I simply talk about it, do we have an integrity issue? Apparently no. Objectivity would be there. Confidentiality no. Professional competency yes. The guy is a qualified actuary. That means he's competent enough to handle this task. Where there will be a self-interest threat, yes, because you're providing actuarial valuation in addition to the audit, so that would be more dependency. Will there be a self-review threat? Yes. The pension obligations are going to be measured by you and the financials would then be audited by you. Intimidation is no. Advocacy is no. Familiarity is no. Conflict of interest in management is no, and no. Now, generally speaking, what happens is that if we talk about the code of ethics, so the code of ethics generally requires you that when we talk about the code of ethics generally require you to segregate the public interest entities and entities other than public interest entities. So that's what the code requires you, that you need to segregate the public interest entity and those entities which are other than the public interest entity. That's what you need to segregate. Now, what we need to do is that if this is a listed company, so what would happen is with the listed company, in the listed company you are not allowed to perform any service which could have a reflection in the financial statements. You're not allowed to perform any of the services which could have a reflection in the financial statements. So that is an important thing, that listed company is not allowed to perform any service which could have a reflection in the financials. Though this 105,000 divided by 35 million must be an immaterial, but then again the code of ethics specifically states that these services cannot be performed. No, you don't get marks. This table is just to facilitate you, just to help you understand that what are going to be, how do you actually identify the various ethical and the professional and etc. issues in a given scenario. So it's good to actually remember these things, because this is the thing that you need to remember these matters against. So I hope that this question clarifies the things. Now let's move forward to the next question. We're going to discuss the next question now. So the next question is, it's June 2013, question number 2. It's June 2013, question number 2. Okay. Now this question's requirement is, which is June 2013, question number 2. The requirement of the question is in relation to the audit of Retriever Group. Evaluate the quality control, ethical, and other professional matters arising in respect of the planning of the performance of the group audit. Now, what I'm actually going to talk about is the important thing is when we talk about the ethical issues. So ethical issues, we do have an idea that how to actually go about with the ethical issues. But now what is more important is the ethical issues are done. But what are these quality issues and what are these professional issues? So when I talk about these quality issues, so you need to understand that what is a quality issue. First of all, when we talk about quality, the quality could be with respect to the engagement. The quality could be with respect to the audit firm. The quality could be with respect to both of them. So when I talk about the quality could actually be with respect to the engagement. The quality could be with respect to the audit firm. Now, if I basically talk about it, what actually happens is that how would we know whether there are any quality control issues or not? So the very simple point of assessing quality is that you need to perform an assessment. You need to perform an assessment if the audit has been conducted in accordance with either. If the audit is performed in accordance with either, then that means that the quality issues are not arising. Now, what are professional issues? The professional issues are generally when practicing your profession. When practicing a profession, the difficulties or the problems that could be arising or that could have an adverse impact upon you or your reputation as a professional, that's what the professional issues are going to be. Now, if I discuss things into this question, it says Kenner & Co. is a firm of chartered certified accountants, is the external audit provider of Retriever Group, a manufacturer of mobile phones and laptop computers. Group obtained a stock exchange listing in July 2012. The audit of consolidated financial statement for the year ended 21st Feb 2013 is nearing completion. So one thing that we do identify here is that the company obtained a stock exchange listing in July 2012. The company obtained a stock exchange listing in July 2012. Now what next? It says you are a manager in the audit department of Kenner & Co. responsible for conducting engagement, quality control reviews and listed audit clients. There are actually two types of reviews. When we talk about the reviews, so there are actually two types of review. One of them is a hot review and the other one of them is called a cold review. Now what is the difference between hot review and cold review? So the hot review is before the issuance of report. Generally what happens is there are few clients which are risky clients. There are few clients which are risky clients, so high risk clients before the audit is finalized. Before the audit is finalized, there is generally So when we talk about the hot review and the cold review, so the review is basically whenever we say hot review, the hot review is before the issuance of the report. So the hot review is actually before the issuance of the report, when the report is actually being issued. So before the issuance of the report, whatever that arises, that's a hot review. Now the cold review is generally QCR, the quality control review, is one of the examples of the cold review. What happens is the report has already been issued. but working papers are reviewed to check if there are any quality related lapse. So basically now we need to consider that what have happened in this question. It says you are a manager in the audit department responsible for conducting engagement quality control review. You have discussed the group audit with some of the junior members of the audit team, one of whom made the following comments about how it was planned and carried out. So now see, it says the audit has been quite time pressured. So whenever you are time pressured, there is actually a risk. So one of the issues is the audit was quite time pressured. The audit manager told the juniors not to perform some of the planned audit procedures as on items such as directors' emoluments, as they are considered to be low risk. So what happens is that the audit procedures, the audit manager told the juniors not to perform some of the planned procedures on items such as director emoluments and share capital. So what happened is the audit manager specifically is skipping things. He also instructed us not to use a statistical technique. That means again either 530 is not being complied. In selecting trade receivable balances for testing, as it would be quicker to pick the sample based on our judgment. So if you see, what is actually happening is the audit has been quite time pressured. The audit manager told the juniors not to perform some of the planned procedures. So if he is going against the planning without any rationale, without any evidence, without any fact, had he actually performed the audit and had he actually figured out that no, there is no risk, then it would have been better. But he is just simply asking them that the audit is time pressured, so you need to skip. So that's a quality related issue. Now he also instructed us not to use forms of statistical methods. So the skipping of a statistical method is a non-compliance of either. In selecting trade receivable balance for testing, as it would be quicker to pick sample based on our own judgment. So that's also a problem. Now, it says two of the juniors were given the task of auditing trade payables and going concern. So it says two of the juniors were given the task of auditing trade payables and going concern. Now, auditing of the trade payable is okay, but going concern is a very important area. So if you allow some junior to actually go ahead with this going concern evaluation, that means you are simply relying too much on small shoulders. So it's actually something which is, that means the firm wide these managers, they actually need training. The manager is not acting in a proper manner. He does not know whom to delegate what task. He does not know the significance of the task. It says the audit manager asked us to review each other's work, as it would be good training for us, as he did not have time to review everything. So now there is a serious issue. There is a serious issue with this audit. The audit manager is simply just trying to get rid of the audit as quickly as possible by get it checked by the people themselves, by getting it, he is actually not acting professionally. He is not acting just like somebody would be expected to act. So apparently his competency is in doubt. He needs proper training. The firm-wide quality control needs to be actually seen, because apparently these people are simply making a fun of how the audit firm operates. He says, I was discussing the gross tax position with financial control when she said that she was struggling to calculate the deferred tax asset that should be recognized. Deferred tax has arisen because several of subsidiaries have been making loss this year, creating unutilized tax losses, as I had just studied deferred tax at college. I did the calculation of gross deferred tax position for her. Now, the problem is the calculations were done by the junior, but another problem is that the junior has been assigned very important tasks. So basically what happens is, that means this is a self-review threat. This is a self-review threat that is arising. The audit manager said that this saved time as we now would not have to audit the deferred tax figure. That's actually playing the management role. It's a self-review thread. It was the management task to prepare financials, not your task. The financial advice controller also asked for my advice as to how tax losses should be utilized by the group in future. I provided her with some tax planning recommendations for which she was very grateful. Now if you see, that's actually a sort of familiarity threat. That's actually sort of going an extra mile. You're planning the management things. You're not been assigned to do those things. Let me just wait for a while. So what happens is you need to actually tell them that this is a serious issue. So if I actually go ahead with this question, I would actually say that if you want to draft this question, so you would actually do it this way. So you see, firm-wide quality needs to be improved by imparting training onto the managers so that they can handle an audit more responsibly. The audit manager has just got rid of the audit without ensuring if he's in compliance with either or not. So the various matters are that the sampling techniques, not adapted, number one. So the sampling technique is not adapted, that's the number one. The number two thing is basically juniors are being assigned key tasks like going concerns. Areas have been skipped on the assumption that they are not key areas. Then there are those other issues also, like for example, you've got some professional issues like self-review threat, deferred tax is shown in financial statements, and those financial statements are audited by us. So these are few important points when it comes to this specific scenario, that these are the quality issues. You're welcome, Zamir. Okay, I hope that everybody gets it. Anyways, so up till now, what have we covered up? We have actually gone through that, how do we actually perform this, how do we actually go through the review of the quality control, ethical and the professional issues. So we have actually gone through this area, and we've also discussed that we have also discussed that how this area is to be answered, because it's actually, if there is a non-compliance of either, there is actually a serious quality issues. So that's what you need to consider, that's what you need to highlight. I hope the above is clear now. So anyone has any questions or anything? Okay, Junaid, I'm gonna share the list of the questions which you should practice, and what you should do is that you should try drafting the answer, because that's what the main thing is. If you have got good grip over drafting the answer, so that's gonna lead you towards the pass. You should know that where are you getting marks and etc. Namina, the professional issues are actually, when we say the professional issues, you see there is actually a terminology which is that if something looks professional or not. Like, its professional issues could be an acceptable behavior, like an unacceptable behavior is a professional issue. Azimullah, but no selective study. Everything is important. Can somebody please share the WhatsApp link here? Okay. Okay, we'll share the list of the webinar. We'll try to send it across. Taj Mahmad Khan, the intimidation threat is basically when you are being threatened by the client, either in the form of financial intimidation, that you would be removed from the client or etc., or at times there is physical intimidation also. Okay, please, guys, would really appreciate if you could share your feedback, so we could actually take it forward, and we would have a mock debrief session tomorrow, so we can we'll discuss and we'll review that mock debrief. You could attempt the paper, you could attempt the exam paper beforehand, so that we could have a discussion tomorrow. Smita, we'll have a discussion tomorrow for the final call, that how do we actually handle this paper till the exam date. Okay, Junaid, I will have a detailed I will have a detailed discussion tomorrow about how to go about it. Smita, I'll share the material tomorrow. I mean, give me time till tomorrow. I'll have the materials and everything shared. Okay, we'll have it shared over the email that is being sent by the webinar administrator.